When you look at a stock chart, does it look like somebody just took crayons and colored all over a sheet, kind of like your best art from elementary school? Are you a trading potato? That's okay. Hey everybody, Walrus here from Walrus Street, and this is the first video of my series 4, reading stock charts for potatoes, like yourself. Also, I do have my Robinhood and my Webull links below the video. If you click on those, we both get some free stocks if you create an account and fund it. Right now, Webull is doing a Christmas promotion where I would be getting a whole bunch of stocks and you'd be getting 4, which is pretty cool. So today's video is going to be focused on the 50 SMA. What is a 50-day simple moving average? Quite simply, it is the moving average of the last 50 days of a stock's closing price. On this graph, it's actually represented by the blue line. You can see it's rising over time, and it kind of fits the curve of the stock price. What's a moving average? To calculate a moving average, you have to go back 50 days. Obviously, if a stock has not been trading for 50 days, then you're not going to be able to do this. You have to wait until it does hit that 50-day mark. Take the day 1 price, day 2, day 3, day 4, all the way up to day 50. You add them up, divide by 50, and that's your first data point. Your 50-day SMA is going to be backwards looking at the last 50 days. The next day would go from day 2 to day 51, and so on and so forth. This is a trading indicator that smooths the price action. The more points you average, the flatter the line is going to be over time. You don't want to take like a 5-day moving average because it's going to give you too many trading indicators. The price action is going to cross the line all the time. 50-day is kind of the good starting point for a lot of traders. Important to note, the 50-day SMA cannot predict the future. It only reflects sentiment. Because it's backward looking, it's an average of the last 50 days. Why not 100? Why not 200? Well, 50-day is the first one that kind of gives traders the idea of what's been happening with the stock lately. And also, it's the first one that's going to show an uptrend or a downtrend. The 100 and the 200 also have their own purposes, and I'll cover them together in a video a little bit later. Some people use a 50-day EMA. This is almost the same thing as an SMA, except an EMA, an exponential moving average, is a weighted average placing more weight on the most recent days.
What does it all mean, Basil?
How do we use this? Here's just a basic graph I created. We've got the price on the y-axis, time on the x, and the purple line is our 50 SMA. If the stock price is above the 50 SMA, then it's bullish. In trading, bullish is positive sentiment or the stock price is going to rise. Here's our 50 SMA. If the stock price is anywhere in this green zone, the sentiment is bullish. Now, if the stock price is below the 50 SMA, then the sentiment is bearish. Bearish would be a term for negative sentiment or unfavorability. Obviously, below the purple line in the red zone, we've got bearish territory. A couple of smaller points for the actual movement of the price action. If the price action hits the 50 SMA and then moves up, think long because it's become a line of support. Now, what does that mean? Let's say we've been trading in the green area above the 50 SMA and the stock price does dip. It hits the 50 SMA, bounces off, and goes higher. You want to think long on your positions. It's going to be a line of support. In stock trading, we usually use words like support and resistance. If we have a price action that is above the 50 SMA or another line, and it comes down, hits the line, and goes back up, that line is support. It's supporting the price. It's lifting it up. If the price is below the line, it comes up, boom, 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 hits it, and bounces back down, then it's resistance. It's kind of like a ceiling. So it's not going to go past that for the time being. Here we can see the price going down, hitting the 50 SMA and going back up. So it is a line of support. You want to think long on the price. What if the price is below, if it's bearish, and if the price hits the 50 SMA, moves back down? So in this case, we were rising, we hit the 50 SMA, price hits it, goes back down. You want to think short term. It's a line of resistance. The stock value is going to be going down for now. If the price action hits the 50 SMA and moves below, start thinking bearish. Now, these are our crosses. So if we were above, the stock price action was dropping, hits the 50 SMA and just passes through like nothing. Then you want to think bearish on the stock. This is where sentiment changes. And on the flip side, if the price action hits the 50 SMA and moves above, then you want to start thinking bullish. So here we were trading below, we hit the line, kept moving up. You want to think bullish about the stock. And when I'm saying think bearish, think bullish, keep in mind the sentiment before was bearish. It was below the 50 SMA, but now we're above, so your sentiment is going to change. There are upsides and downsides to using 50 SMA. It is not a catch-all, be-all, end-all. It's best used in conjunction with other trading indicators that we are going to go over later. Most traders are going to be using something like 10 different indicators when they are making a trade. This is just one of the 10, but it is one of the most important. Upsides. Everybody uses it, which makes it a psychological support and resistance. Almost every single trader, even if they're day trading, is going to have the 50 SMA up on their charts. Everybody's looking at the same thing at the same time. They're all going to be thinking of it as either a support or a resistance. And typically it takes an external event like news, some sort of big transaction volume to move it past the 50 SMA, like an institution swooping in, buying up hundreds of millions of dollars of shares. Of the common ones, 50, 100, 200 days, the 50 is the first line of support in an uptrend and the first line of resistance in a downtrend. That means if our stock price starts going up, then the 50 is going to be the line of support where the price is going to have a hard time passing below it. And in a downtrend, it's going to start going down. The 50 is going to be a line of resistance where the stock is going to have a hard time passing above it. The 50 SMA has a whole bunch of other uses, especially in day trading. Although if you're watching this video, I'm assuming you're not going to be day trading, so we're going to skip right over those. The downsides. The 50 SMA is historical, it's backward looking, and it is a lagging indicator. It can't predict the future. Like I said earlier, it only looks behind 50 days. The 50-day SMA is more impacted by news than the 100 and 200 because it's typically closer to price. The 50-day SMA is going to be following the price relatively closely compared to the other two because they're averaging 100 days back, 200 days back. And keep in mind, these are trading days. This is Monday to Friday, excluding holidays when the markets close. It's not like a 7-day week. This is only 5 days at a time. So a 50-day moving average is actually 10 weeks back. The 50 SMA does really well in consistent markets, less so in inconsistent markets. Now, from about the drop at the end of March until the end of November, we actually had a very consistent uptrending market, and then December has been a little bit rocky. So the 50 SMA was really valuable during the consistent uptrend market, but right now, the market's been kind of going up and down and up and down, a little zigzag, and the 50 SMA is less useful at this point. One thing I do want to point out about the 50 SMA compared to the 50 EMA. The EMA is a little better at gauging sentiment since it's weighted more heavily for the most recent days. Hope that helps. That concludes the first video in this series. If you guys enjoyed it, please like and subscribe. As always, thanks for tuning in.